You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome back, everyone. This is Buck Joffrey with the Wealth Formula Podcast. And today is, of course, Wednesday, the day that we have our little market update with Zulfi Ali of Valerity Group. Zulfi, welcome back to the show.
Good to be back, Buck. Hope you had a nice 4th of July.
Yeah, you too. Bet you spent it with some family.
Yep. I do not travel on busy holidays because I hate the airports and hate the roads when they are at overcapacity, which is what's going on. Apparently, record numbers of travelers, all-time records in on the road and flying over the last.
But you traveled anyway, didn't you?
No, not over the 4th. I was at home on the 4th. I traveled the week before.
Oh, okay.
For like 3 days, but not on the 4th. But
Got it.
I think you traveled though.
I did. I didn't travel like right on the 4th, but I was traveling around that time. I was in San Francisco for a bit, New York, then Minneapolis, and then came home. And then I know you were with your children, and your children are of what age? Remind us.
They are 18 and almost 20 for my son.
Got it. And I bring that up because, of course, the last episode, we talked a little bit about teaching personal finance to your kids. And I'm curious if you had any feedback on that show.
Well, I think it's a great topic. It's something that we should all absolutely focus on. I think particularly since you have, a group of listeners that are investors that are trying to do the right thing with their own financial and wealth planning and investments and all that. I mean, what a great thing to do with your kids as well. Get them involved in all of that process. Make sure they're financially literate. I think you can even go beyond just a very high level manner. You can teach them because I think kids do pick up on lots of nuances, right? So you can go through what debt is, but go through what is good debt versus bad debt, right? Is what kind of debt do you want to have versus what kind of debt you want to avoid. You can teach them about investing. I don't know that I would just give them some trading account, let them trade in there. I think, I've known people who've done that before. Like, here's a couple $100, go learn the stock market.
Yeah, no, I don't.
That's kind of like giving a kid some money at a casino and saying, go learn about, they're not really going to learn much other than I lost the money.
Yeah. I mean, what do you do? I mean, did you actually do anything? Because I know your son Gabriel is he's studying business. I mean, did you actually do anything with him growing up?
Yeah, I mean, not when he was younger. I think your the podcast guest that you had, I think is involving his kids even younger than I did, which I think again is a great idea. But I think with both my kids, I've been keeping them kind of involved in terms of what I've been doing with Valerity Wealth, Valerity Group. What do these businesses do? How to think about investing, how to think about taxes and being efficient. I think at the end of the day, we have to teach our kids to be independent on all this stuff because it's my personal view, but I don't think the days of high-paying W-2 jobs are going to be there, consistently going forward. I think you've also talked about what's happening in the medical profession in the past. Those salaries continue to get hammered. You got high tax rates. The costs of being a doctor means, at the end of the day, your net cash flow is not what it used to be at one point relative to your expenses, right? Because of inflation and all that. And so even professionals need to think about approaching their practice as a business and take, set themselves up as a business if they can, rather than a W-2 earner, and build wealth on the side so that they can retire. So I think those are the same types of things that you want your kids to be thinking about, even when they're, trying to get their first job. It's like, okay, you're trying to get your first job, you're trying to get, your income, but think about all these other things that you need to do for the long term, because at the end of the day, the power of compounding, as Warren Buffett will say, is it's one of the wonders of the world. So he's built his billions on a very long term, active approach in investing, and that's what these kids have that you and I don't have is
right.
Lots of time.
Yeah.
Lots of time.
Yeah. Well, unless we can reverse that, that's my other podcast.
That's I'm listening to your podcast as well because I want to keep compounding, and that's the key to compounding. Maybe you got to change the title somehow.
Yeah, but by the way, like the thing is that when you talk about compounding, I think it's interesting to like people generally, as soon as they hear the word compounding and they put it together with Warren Buffett, they think about it just simply being a matter of stocks, right? But the reality is that we talk about like whenever you make money on, say, a real estate deal and you have a divestment. We just had a nice divestment on a self-storage deal, and a number of people redeployed that right back into this, really distressed asset that we had in Accredited Investor Club. That's a different kind of compounding, right? Because again, you've taken your gains and then you are, deploying those gains into something else. I mean, so compounding is something that, it's not just about the equity markets. You can do that in other things. The whole point is to be able to take your gains and then, and then invest those and get more gains out of it. So
that's right. I think the way to think about compounding is as long as you're not eating your gains, you can compound, right? So, if you want to compound your cash flow, that's a great strategy, right? You start out with your initial investment. That's a cash flowing investment. You take the gains when you're exiting that. You're buying even more assets that are generating more cash flow and so on and so forth. So, that is an important point. You can compound in a variety of different ways.
Yeah, my kids are, still pretty little. I mean, Camilla's 15, but she's really interested in music and all that, and she's not super interested in anything that I do. But I'm thinking maybe she'll grow into that. And the other ones that they're even last week, my little one, Tiny, she was in the 9-year-old. She was like, "What do you do? What's your job?"
Yeah.
And I have no idea how to even explain what it is that I do to her. Yeah. But she asked good questions. She's like, "What is money? And like, how does money come on your credit card?" She thinks the credit cards are just, just spit out money and stuff like that. So, I mean, I guess a good chunk of Americans think that too, but
that's the unfortunate thing.
Right.
Yeah.
Right.
No,
I think it's important.
Ask really insightful questions.
Yeah, it's useful. I mean, it's stuff to think about. It's hard to do. It's hard to remember to teach that, but I think it is probably something that we all have to keep in mind. I certainly don't think I've done a great job of it, but I'm hoping that as they get older, to kind of get them involved specifically in the things that I do will be more meaningful and help to learn. And some of them might get super excited about it and some of them may not, but they'll learn this concept of personal finance, which it's more than just stocks, bonds, mutual funds versus real estate versus crypto. It's where there's a bigger world out there, which I think when I was growing up, I don't know about you, but despite having an entrepreneurial father, I felt like I never really understood what that world was all about. And I was always sort of cued in on, being a professional, being some kind of lawyer or doctor or whatever, and just being really good in school. That's really what it equated to. So I think that if anything that you can potentially do is, to intervene early in that, because I didn't really discover this whole world outside of having a high paying job until, for me, it was reading a bunch of Robert Kiyosaki's books, which, they seem so simplistic in so many ways, but for some reason they really just opened up an entire different, way of thinking for me. And so if a simple books like that can do it, you could probably do it for your own kids.
Well, and that's why I think the simpler the better, because you need, ultimately you need something to do that you feel you can execute. So when you read a Robert Kiyosaki book, you all of a sudden you can come up with a game plan. It's like, hey, I could do this, this, and this, and I can implement that tomorrow, right? And I know what I can keep doing and progressing. So I think there's a practical element to it, just like getting kids involved in your business, whatever insights they can get out of it. They can see how all the different things that go into a business and running a business and then stuff, and that just makes them a lot smarter when they get into a more theoretical education, right? So my son he's in business school, undergrad business school right now, and a lot of what he's going to do is going to be all theoretical on paper, and to get that out into real world use. You have to have just a platform to be able to do it from. So if there's a family business that you can leverage to do that, I think is the best of both worlds.
Yeah, no, and I think that's key. Family business, whatever. I think whatever you can do, it's hard to do that when you don't really know that much yourself. And I think that's where this show comes in. It's interesting because sometimes it makes me think some of these situations are very challenging for people. And when you're deeply ingrained in W-2 income and you have the golden handcuffs and you're trying to figure out what to do, it's not that easy, right?
Yeah.
I was telling a story. I don't know if I even published this yet, but a friend of mine who's like a high-paid physician. And, he's probably like 40 years old. He's making probably, $500,000, 600 grand a year. And he's totally getting crushed by taxes because he lives in California. And he's like, what do I do? I mean, where do I even start? And I had to think about it. And I said, and all sorts of stuff come to mind, like, oh yeah, you should invest in real estate and all that. But the first thing I thought was, okay, well, you got to figure out how to pay less taxes. Right? Mm-hmm. Because that's going to be your biggest bang for your buck right there. And he's not married, so he can't really take advantage of some of the real estate professional designations, like, if you have your spouse doing that kind of thing. But, there are other ways, like, there's a VRBO loophole. Do you know that loophole? It's really interesting. No. And it's something you probably, you're not W-2 anymore, but when you were, this would have probably been very helpful. But there are, the short-term rental, there's a short-term rental loophole actually, which, for whatever reason, like if you have a short-term rental and you can document that you do a certain amount of work on that, and, I'm sure it's not terribly difficult to figure out what those laws are and to document them. But, you can do the same thing with your, with that short-term rental that you can with, like any other real estate, which you can do a cost segregation analysis and do bonus depreciation. But the difference is with a short-term rental, you can take those passive losses, those depreciation losses, and offset them against W-2 income. And I mean, that's like a very, very powerful loophole that a lot of people could be using if they know about it. And for him, it would mean like, okay, you buy an asset, and then and then the return is almost immediate, right?
Yeah.
So anyway, stuff like that. That's what I guess what this show is about. Let's move on. Let's talk a little bit about the market. Certainly we'll get to crypto in a second, but what's going on? What's going on out there?
Well, more of the same in terms of the performance of the market. The equity markets, again, continue to set all-time highs. So, we sound like a broken record from our previous podcast, but that continues to be quite amazing to watch. On the flip side, bond yields are at 3-month lows. So yields are coming down. Particularly, most recently, we just had some employment data that came out last Friday, and that showed that unemployment had ticked up to 4.1%, and that's the highest it's been in 3 years. So it's still healthy. It's not like really bad unemployment, but 4.1%, you're starting to get to levels that were in place before the pandemic. And I think that's right about where we are now. And then Fed Chairman Powell was, as of Tuesday morning, making statements to the Senate Banking Committee. And he is definitely signaling that we're getting closer to cutting rates. He said that the labor market has cooled significantly across many measures, that it's no longer a source of broad inflationary pressures. And that's really, really key, because one of the things that I think the Fed was worried about if they were to decrease the Fed rate was that they would put a lot of pressure on the labor markets, which were really running hot earlier in the year and last year. But they're at a place where now he's saying that there's actually an additional risk. That sounds bad, but it's actually good. What he's saying there is that the risk is not just about inflation, but now it's also, there's a risk that the elevated rates that are continuing to be in place today, they could actually slow the economy down too much. So in a more complicated than necessary.
That's not surprising at all, right? And then and then they've kind of got themselves in this situation where you get a presidential election, they can't be aggressive about anything, even if they really wanted to. They can't do a whole lot.
There's a lot of speculation out there in the market, with different market and economic kind of folks saying, would they cut before, would they cut in September, would they not? There's actually a fair amount of people that actually think he may have to cut in September if things continue to decelerate in terms of the growth in the economy, in terms of employment and that sort of thing. If things kind of really, start getting much worse faster, he's going to have to do that. But we don't know if we're there. And in fact, there's an important, inflation metric coming out on Thursday, which is the CPI. So we'll see how that comes in. That could come in hotter than expected, and then it would make it really tricky for him at that point, because then you got a high inflation, but also a labor market that's cooling quite fast. And so, he'd be in a bad.
Well, remember what Janet Yellen admitted to before, right?
That's right.
Right.
That's right. The housing component is coming down. So, that is a lagging component of the CPI. And so that should help drive down the CPI.
Yeah.
So,
this, so if you think about it, like, who's this guy, Cam, I can't remember his name, the guy from Duke.
the economist that you had on.
Yeah. I mean, he was already speculating that if you use real-time numbers in terms of housing, the CPI already would have been, optimistically around 2.1%. So now if labor markets are slowing on top of that, I still think, based on that data on this, I think it's going to be a precipitous fall in the next, in the fall. So
it could be, and then you'll have some significant rate cuts. But I think even if it's a gradual fall, I think the Fed is really going to be looking to cut rates. Maybe they have to wait till after the election, but it's going to start happening, towards the end of the year. And the markets obviously are pricing that in. So, like I said, the bond markets are pricing that in. The rates are coming down for the 5-year, for the 10-year. So we've seen that equity markets like this. Equity markets are trading nicely.
And I want to, I would just point out here that the real world implication of this is very clear. Like, so we just, in Investor Club, we just did a deal which is massively distressed, right? Like, it was purchased at a big discount, and the thing that people need to, I think, really understand and try to take to heart, because I think there's this fear out there, and I get it, right? I get because no one there's volatility and the markets got crushed. But when you buy an asset, when interest rates are high and interest rates are in a descending environment, the asset prices go up, and so we are in this window right now where interest rates are still high. And if we know that it's, that's almost, to me, it's almost imminent that they're going to fall, that it is, and on top of that, you're getting assets that have been obliterated and that you're getting at 25, 30%, discounts from 2 years ago. You've got to keep that in mind. I'm not giving investment advice, but I'm trying to encourage people to think rationally about the situation. And I know we've got potentially some other stuff coming down the pipeline. It's something that people need to think about. Like if you're buying at high interest rates, when you're buying at high interest rates and you're buying already discounted assets and moving into a lower interest rate environment, that's a very, very positive move, investor move to make.
Well, and especially, and I think the specific, the one that you were talking about, the distressed opportunity, the asset itself, you said it was obliterated, but that's the price, right? The performance is actually pretty stellar. So it's a very high performing asset, but the valuation was obliterated because of the rates environment and the fact that the current owner, the previous owner, had a cap structure that could not be supported anymore because the rates went right through the roof. So it's just and
they had to sell.
Set of circumstances,
and they sold for something like $13 million less than they were going to sell 2 years previously. So so again, I just it's important for people to be rational right now. When there's blood in the street, it's not easy to to have the coronary arteries to put aside emotion and think rationally. But I do encourage people to do that. So, gold. I don't follow gold much, but what's going on?
I don't typically follow it, other than the fact that it has had a tremendous rally, and I'm quite surprised that it still remains at its all-time highs. I mean, typically, when you have part of the cycle where it looks like inflation is coming back down, assets like gold and silver typically are held as a protection to inflation. You would see those prices coming back down again, but no, I mean, gold is holding quite well. I think there could be a couple of factors. One is inflation. If you look outside of the U.S., actually, inflation is actually running pretty high still. So Europe, Asia. So I think there's a big global market out there that is still looking to protect themselves from the effects of inflation. So buyers there. And then we also had talked about it before. There's certain sovereigns like China that are scooping up gold as well as part of their own plans. So that's an interesting one. I'm probably not all that bullish on gold right now. No cash flow and probably not the right environment, but still amazed that it's holding up where it is.
I mean, it's like sort of just a general hedge, right? I mean, if you just kind of you buy your GLD and you want to keep up with inflation, it's probably not an unreasonable thing to do. But Bitcoin has been taking an absolute beating. My crypto portfolio is down $1 million from 3 weeks ago.
Ooh. Ouch. Yeah, that's painful.
Yeah, no, I know. It's very painful. So the people are worried about this, and then listen, at the end you get this welcome to cryptocurrency, right? But there is a story. There are stories. I mean, there is reasons for this, and one of the things that people should know about in this is that there is a huge there's huge pressure here because Germany in particular has something like 17,000 Bitcoin that they have literally just transferred to the crypto exchanges. They're looking to liquidate. And there's so there's that, and then I think there's Mount Gox and some of the other things that were sort of pending that are going to sort of unload a ton of Bitcoin onto the market. So I'm not actually terribly surprised by this. In fact, again, when I look at the markets right now, and if you have Bitcoin sitting around $55,000, I mean, there's a good argument to be buying up Bitcoin. Not only Bitcoin, but like, the one thing that I like to, I've got my eye on Solana. I think Solana is going to do very, very well. And I think it's down to like 130 or 140. That's going to, my opinion
what's the story on Solana? Why is that?
So Solana is sort of like it's a faster, more efficient Ethereum. There's a whole bunch of these cryptocurrencies that are kind of fringe, and they don't necessarily have a lot of support behind them. But Solana has, I think, is definitely sort of number 3 in terms of even the way the institutions are looking at it. Just as a record, I mean, the 2-year high in Solana is only like 200. I think it's, let's see, its all-time high was, I don't know, it was like over 200 or something. It's down to like 140. But if you can grab something, some Solana, that might not be a bad idea. The other thing is, I'm obviously biased on this because my biggest holding is Hedera. Hedera, I think, is massively underappreciated, continues to be. But if you look at what's going on in the developer space, it is by far the most developer activity of any cryptocurrency is in Hedera right now. So just some things to think about as these markets have completely crumped, right? I mean, I think Hedera right now is, I think, sitting under 6 cents. It has been as high as around 60 cents in the last rush. So again, not market advice, but things that I'm looking at that you might wish to consider. Literally, Hedera is sitting at, 6.7 cents, all-time high of 52 cents, and they are a project that actually produces stuff. They really do stuff, and they actually have the Hedera Foundation is actually profitable, which you can't even say that about the vast majority of these.
Sure.
You think so? So anyway, just a few nuggets there. Okay, well let's talk about I guess the next section. We'll just kind of a lot of times we do products, but I think today you wanted to really kind of focus on sort of what to happen as the Fed rates start to move, because of I think what we're both looking at is a fairly imminent move down later on this year.
Yeah, I think it's important to investors kind of look at how they're positioned right now. The environment is looking like we're going to have, a Fed rates cutting cycle coming up. Maybe it begins later in the year, but I think it's going to, it's going to start playing out in the markets. It already has, I think, been reflected somewhat. But as we've talked about already, the equity markets will benefit from a more friendlier rates environment. Particularly given that there's still growth in the economy, so we're not at this point, running risk of a high risk of a recession. What we're talking about is an environment that continues to show growth, healthy growth, continues to show good employment levels, but the rates environment comes down because inflationary pressures have finally eased back off. So, I think corporate earnings will still continue to be decent. What I would expect to see in this environment is that you'll see a much more broadening of the companies that have actually done well in the stock market, because again, we've talked about it the last few sessions. The stock market performance has been really pushed hard and has been concentrated in kind of those 7-8 names, and that's kind of it. The rest of the stock market has not really done much. It's been pretty flat for the most part over the last year. And so what I would expect, lower costs of borrowing is quite important for smaller companies, because they tend to borrow and they can then juice up their growth rates with the lower cost of capital. So I think it could be a good environment for the broader market to show some better performance relative to what it has. So equity markets I like. And remember, there's still $6 trillion sitting in money market instruments. Again, we've talked about that before. Again, when the Fed starts cutting, those those returns are not going to look as good as they are today. I think right now you can get 4.5, almost 5% on some of those money market type of investments. That's not going to last forever, and at some point, investors are going to be, oh, okay, I got to find somewhere where I can get some decent return, and you're going to see some of that coming back into the market. So I think that'll help the equity markets as well. As you would expect, the bond markets will benefit if rates go down. So when rates go down, the bond prices of existing bonds go up. That's where you make a lot of money when in the bond market. Otherwise, you're just collecting interest. But here you can actually see good capital gains on your bond market. So there, I would tend to think it's the what's kind of referred to as the shorter end of the curve. So probably like no more than 5-year kind of bonds. I would keep that exposure to longer tenure bonds very, very minimal, because the rates on those are already very low, and the Fed cutting short-term rates not likely to impact the long end of the curve very much, but it should have an effect on up to like a five-year rate. So bond market should do well if you're focused on shorter tenor type of instruments. And we talked about I think commodities. I tend to think things like gold and silver are going to have a tougher time as inflation becomes less a fixation for investors as we get into the rate cutting cycle. So I'm probably I would probably loosen up on some of my positions there if I had any. And then, as discussed, real estate definitely should benefit here. SOFR rates are very, very closely tracked to the Fed funds rate. The current SOFR is at 5.3, which is where the Fed funds rate is. And if you think that the next cutting cycle we'll see the Fed cut its rate from almost 100 to 150 basis points, that would be a meaningful difference in SOFR, and therefore borrowing costs for
the thing about it is that as these rates come down, and with so much money sitting there in money markets, as you discussed, the transition between a market that's that's still pretty sluggish, like specifically the multifamily market that I'm talking about, we're seeing some things coming off. But that transition is, I think, as rates come down, is going to move pretty rapidly into, it could quite possibly move pretty quickly into froth, because of the amount of money out there. And that's just something people ought to be aware of. So again, taking advantage of where we are is something to really, really keep in mind.
Yep, 100%. Things can change very quickly, in these assets. So I could see a risk of that as well. If assets become very overpriced very quickly once the rate cuts are in place. So I think the interesting thing will be on the real estate side to see what happens in the residential real estate market, because prices there have remained very, very high, and continue to grow. And one of the fundamental causes of that was the lack of supply in the
liquidity,
in the market, right?
People are sitting on houses that they couldn't afford today because they bought them at really low rates, and they locked in for 30 years, and very smart to do so, right? And so there's no houses to buy.
There's no houses to buy, and for the people that want to move, they're it's just a bad trade on the mortgage, right? Because you're trading out of a 2 to 3% mortgage rate, and you're going to be ending up paying 7% mortgage rate. So that is, it's effectively locked those people into place, even if they wanted to sell.
Right.
And so I think what'll be interesting to see what happens is if you're down to 5.5% mortgage rates, could that unlock a lot of supply, and therefore could that then have a balancing impact on the pricing? So rather than residential real estate pricing going way up, maybe it doesn't go up that much. Maybe it feels some pressure because of the amount of supply that comes on the market. So that's something I want to keep an eye on. I think that'll be interesting. And then generally, I think, again, when you have money loosening up and interest rates coming down, you would expect more speculative asset classes to see some activity, and likely rising. So again, I don't know much about crypto, but I put that in there as in the speculative asset classes. So potentially things like Bitcoin and Hedera and Solana, all the ones that you're talking about, could benefit from that type of environment, but also things like venture capital and some of the more riskier type of investment areas.
Yeah. Well, again, I think I think as we get close to this transition in rates and all that, I think it's really, I think the message of the day is start really thinking about deploying, because it's like you have the beginning and the end of the cycles, and this is what we're at right now is in my view is a very beginning of a cycle, where you've got these you've got these things that are coming off with big discounts in real estate. Next, rates are going to come down. Those prices are going to start to come up. You're going to have froth. I mean, that's how the cycle works. And and so be smart, think about it, and look for opportunities. Of course, join the Accredited Investor Club. I think we're going to have another great option for people in August if they are, again, if they meet the criteria of being an accredited investor. Make sure you get yourself onboarded by going to wealthformula.com and signing up for Accredited Investor Club. And that is also going to be an opportunity that is presented through Zulfi and Valerity Group. Valerity, you want to talk about the difference between Valerity Group and Valerity Wealth?
Yeah, sure. Valerity Group is a broker-dealer. So those are, the activity there is to really bring specific investment opportunities to investors. So we help make sure that there's proper diligence done on the issuer, the company that is raising the money. We make sure that it is done in a way that is proper in regards to SEC guidelines and all the regulators' requirements. We also make sure that the investments are suitable for any given investor. So we have a suitability requirement that we have to make sure that investors are meeting for those investments. So that's one part of the business. The other is Valerity Wealth, where we're actually advising investors on from a holistic perspective. So there we work with the investors directly, and we work with them in a comprehensive way to look at their investment strategy over the long run. What are their objectives? What is their risk appetite, risk tolerance levels? How can we make sure that tax mitigation strategies are properly implemented, asset protection strategies, all that kind of stuff. So we take a look at everything that an investor needs to implement in their overall wealth.
Sort of estate and just sort of like just buttoning everything up. And that's sort of like a family office, as we've discussed before. One of the things that it occurred to me that people might want to think about the role of Valerity Wealth might be through self-directed IRAs. These are obviously situations where leverage is a little trickier because you have to deal with UBIT and UDFI, and if you want to have a portion of your portfolio, in sort of more traditional things, although I would say that Zulfi's a little bit different in that, having his experience through the running a sovereign wealth fund, it's not quite as cookie cutter as you might get with your typical 3-month financial advisor training program. So, that might be worthwhile to look into. ValerityWealth.com. Check it out. And thanks, Zulfi, for for this for the time, and it's actually useful. It's kind of good information today, and we'll see you next week.
Absolutely. Thanks, Buck.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.